Most investors believe ESG investing is about ethics. That belief is incorrect. ESG is not a moral movement. It is a capital allocation system. And every capital allocation system exists for one reason only: profit redistribution. Today, we will examine ESG investing using facts, incentives, and capital flow data, not narratives. By the end of this video, the structure behind ESG profits will be completely clear. ESG stands for environmental, social, and governance. In practice, ESG is a filtering mechanism used by institutions to decide which companies receive capital, which companies are excluded, and which assets are structurally supported. This is not theory. Today, tens of trillions of dollars are allocated using ESG scoring frameworks. These frameworks directly influence index inclusion, cost of capital, access to institutional funding. When capital is filtered, winners and losers are mathematically created. This is the first principle investors must understand. ESG did not emerge from ethics. It emerged from regulatory pressure, political alignment, and institutional risk management. Large asset managers face three realities. Governments shape regulation. Regulation shapes capital access. Capital access determines long-term survival. ESG allows institutions to align with regulators, reduce political exposure, and maintain privileged access to markets. This alignment is measurable. Pension funds, sovereign wealth funds, and insurance capital increasingly require ESG compliance. This is not ideology. It is structural adaptation. The central controversy is not whether ESG is ethical. The real question is whether ESG improves or suppresses profit. Factually, ESG funds often exclude high cash flow industries such as energy, mining, and defense. These industries historically generate strong dividends and inflation protection. Exclusion reduces diversification by definition. Multiple long-term performance studies show ESG funds do not consistently outperform broad market indices. Higher fees are common. Correlation between ESG scores and financial performance is unstable. This creates a measurable trade-off. Narrative alignment versus capital efficiency. Despite performance inconsistencies, ESG continues to attract enormous capital. This is not accidental. Large institutions are not optimizing for short-term alpha. They are optimizing for regulatory survivability, reputational insulation, and political compatibility. Capital that cannot risk exclusion must comply. As a result, ESG becomes self-reinforcing. Capital flows create price support. Selected assets receive structural demand regardless of fundamentals. This is how capital systems behave when incentives align. Top profit investors do not debate whether ESG is good or bad. They analyze how ESG reshapes capital flows. The facts are clear. ESG creates artificial demand in selected assets. Artificial demand can support prices for extended periods. However, when capital flows reverse, unsupported valuations collapse quickly. This means ESG is neither a scam nor a guaranteed profit engine. It is a temporary structural advantage. Profit comes not from belief, but from timing and positioning. ESG investing is not about ethics. It is not about saving the world. And it is not designed to maximize returns for everyone. It is a capital filtering mechanism designed to serve institutional survival. Those who understand this profit. Those who believe narratives do not. Top profit investors follow incentives, not stories. And incentives always leave a trail.